10 Clever Tips to Get a Personal Loan in 2022. One of the most popular types of loans in the market today is the personal loan. Personal loans come in handy when there are planned or unplanned expenses like vacations, weddings, or medical emergencies that go beyond your financial capabilities. Before starting, support the channel by liking this video and subscribing to this channel for future updates. People require money for one too many reasons, especially with COVID-19 bringing the economy to a near standstill and in turn, adversely affecting the lives of many. This explains why in India, 77% of working individuals rely on personal loans to make ends meet. Taking a personal loan is considered to be a great option if you can comfortably make the repayments during the tenure of the loan. That said, to qualify for a personal loan, you need to fulfill the eligibility conditions laid down by the lender. In this video, we are going to learn all about personal loans and how you can improve your chances of getting a personal loan. What makes personal loans ideal? Before we take a look at the personal loan eligibility and the benchmarks that you need to meet to get your loan application approved, let's understand why personal loan has shot to fame and become a preferred option for many. One of the primary reasons why personal loans are opted for is because they are unsecured loans. Unlike home loans or car loans, the borrowers need not provide any form of security or collateral to the lender to avail of the loan. As there are no collaterals required, the documentation required to apply for the personal loan is much lesser compared to any other type of loan. Another key reason why people opt for a personal loan is that, once the borrower gets approved for a personal loan, they can use the fund for any purpose they deem fit. The lenders do not restrict or limit the end use of the funds secured via a personal loan. From paying off long-standing debts, car or house down payments, and outstanding credit card bills to funding a function or home renovation, there are a plethora of expenses that can be funded by using a personal loan. Number 10. Inquire about loan prepayment. In most cases, the borrowers are allowed to prepay their loans. While you may opt for a longer tenure, it is good to always check for an option to prepay your loan amount. There are a few changes to be able to opt for the prepayment of a loan, but doing so will save you from the high rate of interest that you will otherwise have to bear. Number 9. Be a disciplined borrower. Financial institutions also consider borrowers who have multiple forms of credit that they're able to pay regularly. For example, you have 3 credit cards with a total credit limit of 150,000 Philippine pesos and a car loan. You pay these debts on time, every month. It shows you can maintain a good credit standing while managing to pay multiple forms of credit. However, don't borrow more than you can afford. If you already have multiple forms of credit, but you can barely pay for them, a personal loan may not be the best idea. Number 8. Be sure to mention all of your income sources. When you are applying for a personal loan, you need to show that you are capable of repaying the loan amount. So instead of just providing your basic income details, make sure that you furnish information about any additional income that you are earning, such as rent. This will not only boost your chances of getting a loan sanctioned, but you will also be eligible for a higher loan amount. Number 7. Improve your credit history. That brings us to our next point on improving your credit score. Lenders pay a lot of attention to your credit score while scanning your loan application. As mentioned earlier, as a part of the eligibility criteria for a personal loan, you need to ensure that you have a good credit score. A score of 750 or above is considered to be a good score. The lesser the credit, the lower your chances are of getting a good deal on your loan application. Some of the best ways to improve and maintain a good credit score are paying your EMIs and credit card bills on time, diversifying your credit portfolio, and reducing your DTI and credit utilization ratio. Number 6. Choose your lender carefully. Before you settle for a lender, it is best to do a thorough research of all the available options in the market. Even though there might be a dire need for funds, avoid settling for the first lender that you come across. In recent times, there has been a wide range of financial players that are flooding the market with favorable lending conditions. Do a stringent check to ensure that you do not miss out on the available offers. Number 5. Avoid applying for too many loans at the same time. When a borrower needs emergency funds, they may end up applying for a loan from multiple lenders to increase their chances of getting their loan approved. While this might give them the hope that they will get approval from at least a few of the lenders, this is certainly not the best way to go about it. Every loan application leads to a hard inquiry on your credit report, and this will reduce your credit score eventually. Number 4. Apply for the right loan amount. To get your loan application approved, you need to apply for the right amount. Before you head to apply for a loan, Use a personal loan eligibility calculator to check on the amount that you are eligible for based on the income that you earn, your current liabilities, and other factors. Number 3. Add your spouse or parents as co-borrowers. In most cases, there is a choice to include your spouse or parent as a co-applicant. This helps especially when your credit profile is not satisfactory or up to the mark. If your co-applicant's income and credit score are high, then including them will up your chances of getting a loan as it will add to your repayment capabilities, fetching you a personal loan at a nominal rate. Number 2. Track your fixed obligation to income ratio, FOIR. When you end up using a high percentage of your income to repay existing debts, this, in turn, reduces your creditworthiness for securing new loans. This could lower your chances of getting approval for a loan, or worse, the lenders may even charge you a high rate of interest to cover up for the added risk. Always ensure that you are maintaining a FOIR of 40% to 50%. To increase your chances, you can consider paying off your liabilities and credit card bills. Number 1. Be realistic with your numbers. Make sure you're borrowing an amount you can realistically pay. You can use the debt-to-income ratio to measure how much of your salary should go to loan repayments. The debt-to-income ratio is a personal finance measure that compares an individual's monthly debt payment to his or her monthly gross income. That's it from this video. Let us know what you think about the list in the comment section below. If you enjoy this video, please like the video and also subscribe to our channel. Thank you.